Markets are manipulated. And in this video, I'm going to show you different examples of how they are and also how you can trade them with the manipulation instead of against them, because you're probably getting screwed over and you don't even know it. So let's go ahead, show you a few different examples of what I'm talking about, what I mean by manipulation, and how everything works. Markets move in a lot of different ways, right? If we think about how markets actually move, it's just buyers and sellers, right? But there are certain funds, institutions, banks who trade with millions of dollars, if not billions, on certain positions. And when they're trading with this amount of money, they can essentially control where price is going. Sounds crazy, but it's actually true. So I'm going to show you a few different examples here of what I mean by manipulation, how to identify it, how you can trade it for yourself. Okay. So the first thing we're going to talk about is Boeing. Okay. Now, markets are used in a few different ways, right? Manipulation can occur in terms of the technical charts and also in terms of news events, right? Because everybody knows if there's something like Boeing, a stock has really good earnings and price jumps up, you're going to have a lot of retail people who are looking to buy. That's just naturally how the world works, right? If a company has good news, good earnings, a lot of people are going to look to buy that stock. And what happens is that if institutions or funds, they know that a lot of people are buying stock, they can use that as their liquidity to end up going short and vice versa. Okay, so let me show you an example here on Boeing of exactly what I mean. So Boeing, very, very nice looking stock. Now, a lot of how markets are moved can be identified using supply and demand. Now, I have an entire free course going over that. I'm going to leave that in the first link in the description of this video, so you can check that out after. But right now, I'm going to show you kind of how supply demand is used with this manipulation and earnings and other news events. So if we're taking a look at Boeing, right here we can see we have a really good supply zone, right? Price for the past few months, honestly, pretty much the entire year, was just consolidating. And then right before earnings, or as earnings coming up, we get a huge move higher. Okay, earnings looks like it beats expectations. Really good news. We end up going higher as expected, right? So you can almost bet that before earnings came out, right, institutions were already loading up down here in the few days prior, okay? Now, when earnings comes out and we see this huge move higher, we already know that a lot of people are going to be buying, right? You can obviously just tell that by the price going up, and also the fact that any company that has good news, good earnings, there's going to be a lot of retail traders who are simply going to be looking to buy in this area, right? All the way up here. And over the coming weeks and coming days, right? So this entire zone here, probably a lot of people, retail traders who are up buying. Now, while that's going on, you probably have institutions who are selling, right? Because if you think about it, they're always getting in before the moves happen, okay? If you think about an institution, trust me, they're not going to be the ones buying after earnings has come out or after the news events come out, okay? They're always getting in before it, right? So they are the ones that are buying down here. They're selling all the way up here into the liquidity that retail is buying, okay? So if a bunch of retail is buying, they need sellers to match their orders, and that's where the institutions come in, they get filled, okay? That's, in a sense, how it works. Now, the actual manipulation doesn't even come from there, okay? Here's where it actually stems from. If you look at what happens after the fact, price ends up dumping down, okay? So price ends up going lower, and we can see that we end up coming right back down into this demand zone. Now, supply and demand works wonders, okay? Again, I can go over multiple ways how that works, but that's not where the real manipulation occurs, okay? You can see a few different things. Now, if we look at this day right here, okay, this is on the 24th. We have a gap down on Boeing. It's a pretty decent-sized gap down. Okay, we don't typically get a lot of big gap days in Boeing. Now, if you take a look at SPY, you may think, well, maybe SPY had a gap down day, right? If you go to 24th, which is right here, SPY actually gapped up. Okay, SPY had a pretty decent gap up that day. Okay, so the market gapped up and Boeing gapped down. And that tells me there was probably news event. I don't have my news calendar pulled up, but you can just assume by everything is telling you that there's probably news that drove price lower. Okay, so let's think about this for a second. We have price that moves up, right? We have a lot of buyers up here, and then bad news comes out, they drive price lower. And where do they drive price? They drive it right into a demand zone. But here's where it actually gets really interesting, okay? You can see if I zoom in, I'll just go down to a 1 minute chart, okay? Right after price hits demand, we wait about 1 or 2 hours, more orders are getting filled, the institutions are buying back their shares. look at this spike. We get another news event right after price comes down into demand, and it spikes right back up. Okay? You can see the manipulation all around, right? They drive price higher with earnings. Okay? Price stays here. A lot of, retail traders, they're buying in this area. They're buying, buying, buying. Bad news comes out, okay? Retail is very, they trade a lot with their emotions. So when price comes back down, especially on bad news, they're selling. Oh, price goes down, down, down. They're selling. While they are selling, institutions are buying back their shares. They're buying it all as much as they can. And then the news event comes out, they push price higher, and then they sell all the way back up here. Okay? That's just the name of the game. That's just how markets are played. Okay? It's very simple. It happens all the time in every market. That's just how the game is played. Let me show you another example on Dell. Dell, same thing, right? Really good earnings. This was like yesterday or 2 days ago, right? Massive gap up from 56 all the way to 68, okay? Really nice looking stock, okay? So what happens? Well, if we take a look, we have first off, really solid demand zone right here. Okay, and you can pretty much just see price comes down, taps that demand zone right before earnings, and then rips, okay? So now let's take a look at this. What happens before earnings, right? Well, demand zone forms, they push price higher, right? You have a lot of people who are probably looking to get in long for earnings, maybe in this area, this 57, 56 area. And 2 days before, price gaps down. Okay, and in this area, you can probably bet a lot of people who are in long in this area up here on the 56, 57 levels, as price comes back down, they probably sold right into this level down here. Okay, and as they were selling, right, we have a huge gap down, probably news as well. We get this gap down, institutions are loading up as many shares as they can in this dip. They are buying this dip like crazy, okay? Getting as many shares as they can because they know, right? They know what's going to happen. So they buy this dip, and then earnings comes out, and the people who got stopped out down here ended up selling the bottom, and now they're looking back and thinking, wow, I should have just held on to my shares. What was I thinking? But that's the name of the game. That's all that's happening, okay? So how do we actually trade this move? How do we actually come up with a strategy that works for this? Now, what I've done is I've made a free training going over exactly this, my 3-phase system that I use to trade. I'm going to leave that also in the description as well, along with that supply and demand course. But I'm going to give you a quick overview now while you're with me. So taking a look at Dell, right? At the end of the day, it really comes down to supply and demand. Okay, now if we're looking at different supply and demand zones, we can see Dell had a really solid demand zone right here. We came down right to it and we ripped higher. And you can use this for pretty much anything, right? We can see Dell came back down to this demand zone right here, right? So we have this move up, this 1 day of balance, nice move higher, come back down inside, and we end up ripping higher, okay? And this happens on all occasions, happens all the time, right? Go back to Boeing, same exact thing. If we can see supply and demand, price comes out, come back inside, and we go back out, right? And you can see the manipulation in pretty much all areas, right? Not just supply and demand. If we take a look at Boeing, right? You simply just need to think, what is retail thinking? If you can understand what retail is thinking, you can make a lot of money, right? So, for example, let's take a look at here on Boeing. We have this massive consolidation period. Okay, this is like a 5-6 month long consolidation period. A lot of retail traders are mostly long. Okay, that's typically how they trade. They invest, they get long term. They buy in this area. Okay, and then what happens? Price ends up coming up, just like this. We ended up trying to break out of this quote unquote flag, right? At the end of the day, this is just a huge bull flag, right? Classic retail pattern. So everybody sees this, price is breaking out, and then everyone decides to buy right out here, okay? And as that's happening, price ends up dumping. So you have a lot of people who are buying up here at the 220s, 225 area, and price ends up dumping. And then so what happens after price dumps? They shake out everybody who bought down here, right? Institutions loaded up back here at demand, okay? It'd probably be on like a 1 hour chart. Let's see where it goes. Yeah, so we have this quick wick off here, just like this, back from this demand zone as well. Come back in, hit demand, move back higher, then the whole earnings shenanigans happen, and it's off to the races after that, right? So if you can understand where retail is thinking, how, classic retail patterns, bull flags, bear flags, breakouts, and simply looking for the opposite reaction. So in this case, a false breakout. You can then wait for the pullback. Now retail has been shaken out, and then the real move higher can happen after that. Because for the real move to happen, they need to shake out retail traders. That's how institutions and hedge funds get their liquidity in order to trade the actual move, okay? Because you got to understand, these guys are trading with millions, if not hundreds of millions and billions of dollars, okay? And they need to be able to find the shares to buy those, okay? They can't just market order buy 100 million shares, okay? That's not how it works. And so they need to use retail liquidity in order to fund their purchases, okay? So hope you guys enjoyed this video. I went in depth a little bit in some manipulation. You can see the examples with Boeing down here with the news event right after it hits demand. Hopefully this helps out a lot. Like I said, I have that free supply demand course in that first link in that description, along with a free training I made for you as well, going over my strategy. But with that being said, subscribe, leave a like down below, comment other videos I should make, and I'll see you guys on the next video.